Within the BFSI space, while banks offer the opportunity for steady medium-term compounding, it is the players within the financial services industry, such as life and non-life players, AMCs, depositories, exchanges, fintech players, etc., that offer fund managers an opportunity for significant alpha creation. And this is the segment that investors can get exposure to through a specialized BFSI fund. These were views expressed to us by Dhaval Gada, fund manager at DSP Mutual Fund. Watch this interview for in-depth views on the prospects of the BFSI sector and also to learn about how to handle the higher volatility that is inherent in a sectoral thematic fund. Good afternoon, Mr. Gada, and welcome to our show.
Thank you, Sanjay ji. Thank you for having me. It's an honor to be here.
So, DSP Mutual Fund has launched the new fund offer for a banking and financial sector fund. We thought this was a very good occasion to examine the prospects of the banking and financial sector and also some of the risks that investors could face in a fund such as this. My first question to you is, purely from a returns perspective, how has the banking and financial sector done?
Yeah. So if you look at last 19 odd years of the sort of BFSI fund, its index has delivered about 17.4% CAGR return versus Nifty of about 14% CAGR. So that's the kind of alpha generation that this theme and this segment has generated for investors.
What are the prospects of some of the key segments going forward? Let us discuss first the prospects of banking and NBFCs.
Yeah, so in terms of banking, we have seen about close to 13 to 14% CAGR in asset growth and similar CAGR in terms of operating profit growth. However, the
over what
earnings
period is this?
This is since 2000, so about 23 years data. We have seen volatility in earnings during this period, impacted by the NPA cycle. However, if you look at earnings CAGR, as the earnings have normalized in FY23, it has been similar at about 14% or so. So this is as far as banking is concerned. Overall, one of the steady large businesses in India. In terms of NBFCs, the CAGR is roughly about 16% over last 20 odd years. And in terms of earnings during this period, it's been close to 18% CAGR from an earnings standpoint. So that is the power of NBFCs, including HFCs, during the last 20 odd years. So blended, if you put lending together, it is broadly about 15 to 16% CAGR. That's the story as far as lenders are concerned.
From a more fundamental point of view, where will the growth come from?
So growth is driven by three things. First is in terms of financialization of economy itself and formalization. So that's driving one leg of growth when more and more individuals are getting impacted by credit and into their day-to-day life as well in the last few years. So that's one theme. The second is GDP expansion itself, which drives business growth and overall opportunity for the banking system. And the third is the corporate recovery, capex recovery that we see. We are in probably year 2 or year 3 of this recovery. And that will drive one more layer of acceleration for the growth. So from next 3 to 5 year perspective, I see economic growth, formalization of economy, and corporate credit growth revival to drive overall growth similar to what we've seen in the earlier period.
The recent big news in the banking sector was the increase in risk weights by RBI. How do you expect this to impact growth?
So I see about 1 to 2% moderation in the retail credit overall, retail credit growth overall from this circular, given that the regulator is concerned about the pace of growth, and we expect regulated entities to support the regulator's view and make the growth far more structural, far more strict from a growth standpoint. We expect them to react to the regulator in a more meaningful way and give the risk weights. Given the risk weight increase that we've seen in the last 3 to 4 years. So in September 19, the regulator had cut risk weights from 125 to 100% to support growth, and in the subsequent period we had seen acceleration in retail credit until COVID hit us in March 2020. A similar, on the negative side, we expect a similar trajectory over the next 6 to 12 months to come. Could be about 1 to 2% impact. As far as the capital adequacy of regulated entities is concerned, I do not see too much impact from a capital requirement perspective. Obviously, the capital adequacy does come down. One reason for that is, post ILFS, the system moved to leverage levels rather than capital adequacy. So we have a bare minimum, which is the capital adequacy, and then there is leverage, which is what the market and rating agencies are more focused on, and that's much higher threshold. So from that standpoint, don't see any major capital requirement in the system. But yeah, we'll have some growth impact.
Could you tell us a little about the prospects for private banks and public sector banks? How do you see them performing going forward?
So over the last close to 20 years, we've seen consistent market share gains by private banks, and in the period of 2015 to 2020, we saw sharp acceleration of market share gains for the private bank. Subsequently, PSU banks, as the corporate NPA cycle sort of ended somewhere in 2019, they have started to come back on growth. And over the last year or so, 1.5 years, we've not seen too much market share loss for the PSU banks, and they've tried to maintain share. What we do expect is this trajectory of market share shift from PSU banks to private banks to continue over the next maybe 10, 15 years. But the pace that we saw in the last, you can say 5, 7 years, that will clearly not be the case, and it will be far more, calibrated in terms of market share shift. So we do see within PSU bank reasonably good prospects of investment opportunity and capitalizing on these investments in our fund as well. Overall, we do see private bank to gain share, but within PSUs, we do see certain businesses maintaining their share.
So in the recent past, PSU banks have also done very well on the exchanges. What is driving their turnaround? Which segments are they focused on?
Yeah, so there are two key reasons which has led to, or rather three, I would say, which has led to this sharp move. The first one is the recovery cycle of bad loans, the NPAs, which like I mentioned earlier, in 2019 the corporate NPA cycle peaked. PSU banks in general were not very badly impacted in COVID from a retail NPA cycle perspective, and hence their asset quality kept on improving during this period. So that is one impact, a positive impact. The second is credit growth market share loss, which was very sharp earlier. That sort of so they started matching system growth, and therefore they lost very limited market share over the last couple of years. So that is the second reason that the growth rates came back for PSU bank. And the third reason is the ownership structure. One of the biggest impact for private banks was the a significant over ownership going into COVID March 2020, whereas PSU banks were relatively under owned. And as earnings started surprising positively from a credit growth and asset quality perspective, we saw a sharp rise in stock price and multiples for PSU banks, and that has created a lot of wealth for investors in the last few years.
Now, let us talk about some of the other segments within BFSI, like life insurance, general insurance, AMCs. What are their prospects?
So I am very excited about a couple of these opportunities that you talked about. Let's start with life insurance first. So overall, our penetration levels are about between 3 to 3.5% in life insurance. We are around the world average, give or take few basis points. Overall, in our long-term assessment, we see life insurance sector to deliver growth similar to the GDP growth. However, in this segment, there is one story which is similar to what we saw in banking, which is market share shift from PSU to private. We expect that this will help private sector life insurance companies to have a slightly better growth profile compared to PSU counterpart, and hence that's the opportunity that we are focused on. Coming to non-life, I'm very excited about the long-term growth prospect of this industry, and I'll also talk about what's impacting the industry. In terms of long-term growth prospect, we are right now at 1% penetration. We looked at data for the top 20 markets globally, which account for roughly 90% of world market in non-life. And what we observed is, most of these markets have anywhere between 2 to 6, 7% penetration as a percentage of GDP, whereas India is right now at 1%. So the point that I make to investors is, if our nominal GDP grows at 10%, and if penetration improves from 1% to 2%, that itself is a 20% CAGR for non-life sector. So that's one strong growth opportunity that we expect. It's already there, and it's likely to continue in the future as well. The issue in this sector is competitive intensity, and that has led to profitability being challenged. It's the only industry subsector within BFSI which is loss making at an industry level as of FY23. So that's the issue. So we are focusing on this growth opportunity, but at the same time, we are cognizant of risk associated with profitability for this sector. So that's on non-life and its growth prospect. Coming to asset management, it is one more very strong investment opportunity. Again, our penetration levels are significantly below the other leaders as far as large countries are concerned. So the point that we made here was India is the fifth largest economy with 16% penetration. If you look at all the 5, 6 economies around us, we are significantly below them. And again, we see long-term, strong compounding in this category from an asset mobilization perspective. We do understand, and we've seen that over the last 10 years as well, that the revenue growth has not been or has been lower than the AUM growth. But what we've also observed is the profitability is actually very similar to the AUM growth, which means that the industry has managed to cut costs and maintain profitability. So again, it's a very sort of one of the solid opportunities within the banking and financial services space with significant growth prospect in the medium to long term.
Now, the Nifty Financial Services Index has underperformed the Nifty 50 over the past 4 years. What are some of the reasons for this underperformance?
Yeah, so I one or two of them. So one reason which I would again like to highlight is the over ownership of BFSI going into COVID, which where investor expected the sector to compound at a particular pace, and it got impacted because of growth and asset quality in 2020 and 2021. What this led to is, Nifty Financial Services Index underperforming Nifty by 10 percentage point individually in 2020 and 2021. Subsequently, there was recovery in CY22 with the balance sheets far more cleaner, well capitalized, ready for growth. There was recovery in 2022. However, we were impacted by one of the largest merger announced in BFSI space, which with that merger announcement, the particular company was impacted from a multiples perspective, from a return ratio perspective, and that had its own impact on relative valuations for other companies within the banking space. So that's been the story of BFSI, that overall on a 4-year basis, we have seen an absolute underperformance of about 23% compared to Nifty, and on a CAGR basis, approximately 4% CAGR underperformance. We do see, some of these issues that we've discussed around growth sort of normalizing, and we've already seen how a regulator has now come and curtail some of this exuberance on growth. So basically, growth has come back, earnings have come back, and as far as the merger related impact on valuation, relative valuations are concerned, we do see them also normalizing in medium to long term.
So your presentation talks about the fact that you are very positive on the sector going forward. What are some of the reasons?
So the first reason that I have highlighted to several investors and made this very clear was the downside remains very low as we speak. So from a entry perspective, we are at a very solid risk reward where returns on the upside could be very meaningful, and on the downside, the drawdowns could be very minimal in our view. So risk reward is very favorable. That's point number one. Second, as we discussed, the growth prospects of various financial services space, not just banking, but beyond banking, the growth prospects remain fairly exciting to us. And we also have highlighted some of the opportunities outside of insurance, of lending, of asset management, which is in exchanges, depositories, platform companies related to financial services. So there are a lot of opportunities beyond banks that we are very excited about from a growth standpoint, and we do see valuations to be reasonable in many of these cases. So that's the second point. And lastly, as far as some of the the banks are concerned, which is predominant part of the BFSI as we speak. About 60% of BFSI is banks as of now from a market capitalization perspective. We do see medium term there is reasonable compounding to be made in this pocket as well. So overall, from a medium term perspective, if an investor comes from a 5-year view, we do see significant alpha generation opportunity for the investor compared to the benchmark.
You talk about the investment approach that you aim to follow in this fund. Your presentation talks about a concentrated approach in a concentrated fund and active share, high active share. Could you explain these points for our viewers?
Yeah, sure. We'll do that. So what we observed is, long-term wealth creation and BFSI is done by a limited set of companies, and hence the approach that we've or I have followed over the last 7 years in the investment side is to have very solid stock picking and reflect that in high weight within the model portfolio or the real actual funds as well. So that's been the approach. Focus more on stock selection and alpha generation from selection. So from that standpoint, my approach to investment within the BFSI space is very bottom up. I'm not focused on labels of quality, growth, value, momentum, PSU, private. Just focused on the company and its prospect from a bottom-up perspective, compare and marry that with the view that I have from a top-down perspective. So that's just the focus to generate alpha for the investors. In terms of the number of stocks, it will be between 20 to 25 stocks. That is where I think the ideal portfolio can be constructed with a balance of some compounders, some medium-term growth opportunities, medium-term return opportunity, alpha generating opportunities for investors, and as well as some tactical plays in the very short to medium term. So that's where I think 2025 stock portfolio can generate reasonably good alpha for investors.
Could you elaborate on the point about high active share? What does that refer to?
So if you look at the benchmark for the BFSI fund, it's the Nifty Financial Services PRI, which has very significantly high concentration to banks. More than 75% of the benchmark is banks. And my approach is, right now to have significantly lower share to banks, which means that the active share compared to the benchmark will be much higher. So that's the whole idea that benchmark just gives you a reference of what kind of return it can generate, whereas the fund focuses on bottom of stock selection, which helps us generate significant excess over the benchmark. So that's the approach. Not focus on benchmark stocks, and just not focus just on the benchmark stocks, and have a much higher active portfolio management approach, and hence the active share will be significantly higher compared to what investors are normally used to seeing in a diversified fund or a large cap.
Your presentation also talks about taking exposure to global stocks. How much will that exposure be, and what is the idea behind including global stocks in a BFSI fund?
Yeah, so let me answer the second part of the question of why look at global stocks, and then I'll come to what is the sizing that we think about. So the approach here, what we realized is that there are certain set of businesses that are not available in India and are only available outside India within the BFSI space. And we've seen that there is reasonably good opportunity from a long-term standpoint to generate excess return for investors. And just to give some certain examples here, there are some payment companies outside India which have been long-term wealth creators for global investors, which some of which will not be able to sort of have participate in being just in India, and that is one pocket that we are focusing on. And then there are other opportunities in the fintech space where there is reasonably a good basket of global stocks which have generated returns and have been profitable as well. Bought at right valuation, they can also bring alpha generation to investors here, and also bring diversification point into perspective. So those are few opportunities that we are looking at, very differentiated. The idea is not to go outside India and buy a traditional bank, or just focus on lending business, because those opportunities and those set of businesses are more than plenty in India and available in. We can identify those opportunities in India itself and generate excess return. So that's not the focus. The focus is some of these businesses which are not present in India. Coming to the other part on what is the maximum weight, minimum weight. The fund can have 0% global, and on maximum it can be 20% global. My approach and thought process here is that we'll go very gradually in this direction, and in the initial period it could be 0 to low single digit percentage point exposure, and over a period of time, as we see success in our investment approach, we will accelerate some of these ideas globally as well, and bring more diversification to the portfolio, as well as significant alpha generation for the investor. The focus is to generate alpha. This is one more layer of opportunity that we see.
Now, the BFSI space is also one that gets hit by risks from time to time. In the last 10 years, we have had demonetization, NPA crisis, ILFS, DHFL, Yes Bank, Lakshmi Vilas Bank. Could you elaborate on the risks that an investor faces when he goes for a BFSI fund?
So given that we've seen so many events in the past, and it's an economy-linked sector at the end of the day, we are likely to be it is one of the high-risk investment, which is what we've also called out from a riskometer perspective. In terms of hence the horizon for the investor has to be long term, is the way we think about it. Minimum 5 years, and the longer it goes, the better the outcomes can be for the investor. One data point that we've always shared to investor in this presentation as well is that the benchmark for this fund, the Nifty Financial Services PRI, has seen 100% beat versus Nifty on a 10-year rolling basis. So that's the kind of hit rate if you're invested in the sector from a long-term standpoint. So that's as far as return and risk is concerned. In terms of other, so basically we'll see events time to time, and the regulator, the industry, the government, everyone will try and avoid the impact of this. But definitely, COVID is one example. ILFS is one more example, and there are many more examples in the past. So I think when the investor comes in, long-term horizon is very important to generate a significant excess return over the markets.
I think there was an interesting data point that if an investor holds this index for more than 7 years, the returns exceed 12% 90% of the times.
Correct. Correct. Yes. So that's what we are trying to highlight, that bring long-term horizon of investment to this space. It is, while it is classified under thematic category, but the sector itself is so vast and diverse that it itself can be a very diversified opportunity. And one more point that I've highlighted investors is, if you were to look at BFSI in 2017, it used to be about 16-17% of market capitalization, which is 23% today. In 2017, close to 70% of the conversation would have been around banks, because that was the value of banks as a percentage of the total market capitalization of BFSI. Today, that number is down to around 60% or so. And so basically the sector has grown, banks have not gone anywhere. It's the FSI space which has created opportunity for the investors. And hence, the focus has to be away. So while investors come back and say that they have BFSI in a diversified fund as an exposure, but what we've observed is most of that exposure lies in just banks, whereas the fund manager in the BFSI space has to look at active opportunities, not just in banks, but outside to generate this excess return, which are out there to be made for investors.
So my next question was actually about the overlap between the exposure to BFSI and even your own funds have a lot of exposure to the BFSI space. I think most of your funds have 30% plus exposure to this space, your diversified equity funds. So then why add another fund to the mix? Why should investors include another fund in their portfolio?
So the key reason is most of these funds have different mandate, and the fund management style can be different. Specifically, when investor comes in a BFSI fund, one, he's getting a very specialized, sharp focus fund manager who looks at these opportunities, not just what are there in the benchmark, but significantly more which are outside of benchmark and have potential to generate excess return time to time. So there is a dedicated focus that comes in, and we've seen some of these opportunities, the FSI opportunities, be it in insurance, in asset management, in capital markets business, wealth management. Some of these opportunities are growing at significantly fast pace compared to the bank's opportunity and becoming larger and larger. Many of these opportunities lie in the mid and small cap space, which a diversified fund or a large cap fund may not look at actively in a meaningful way, given its size constraint or the fund manager style, etc. So that's where a dedicated, BFSI fund, which is completely looking at bottom-up opportunity, can help the portfolio bring diversity and participate in a long-term value-creating theme, which we've discussed earlier in the conversation. So that's where the diversification comes in. That's where the style differentiation comes in, and alpha creation for the investor comes in.
Now, any sectoral or thematic funds tends to be far more volatile than a diversified equity fund. What should be the profile of the investor who comes into this kind of a fund? What kind of an investor should take exposure and who should avoid these funds?
Yeah, it's a fair question. So, investor should bring long-term investment horizon when he is looking at a sectoral thematic fund. So, at least 5-year horizon should be there, and if 10-year would be excellent, but 5-year plus horizon should be there. The second is investor should be prepared for a slightly more drawdown compared to a diversified fund, but at the same time. When the investor comes from a long-term perspective, the mean reversion or the catch-up, takes place, which we've seen in the rolling returns as well. So that's the sort of mindset of an investor should be such that he should be willing to see slightly more drawdown, but at the same time bring long-term horizon to generate that excess return for the portfolio as well. Yeah.
So broadly, to sum it up, what you have said is that a fund like this will give you better exposure to the FSI space within BFSI. And to the investor should also have greater risk appetite when coming into these funds. And one way to handle the higher volatility in these funds would be to hold on to them for, say, 7 to 10 years.
Yes, absolutely.
Thank you, Mr. Gada. It has been a pleasure. I'm sure our viewers will gain immensely. They will get to know more about the BFSI space from this conversation. It has been a pleasure speaking to you.
Thank you, Sanjay. Thank you for having me, and hope to have this interaction. Yeah, thank you.
Goodbye. Have a nice day.